financial websites like Zero Hedge and Seeking Alpha, you'll probably have noticed that investors are obsessed with interest rates. These sites dedicate almost as much time to watching the Fed's moves as they do writing about stocks, and most of the time, the implication is that the Federal Reserve is causing big trouble in the economy. This year, the big concern is higher interest rates. The Federal Reserve has been hiking interest rates since the first quarter, and the S&P 500 is down about 18% for the year. It really does seem like these rising interest rates are bad for the stock market. But the question is, why? In this video, I will explore exactly why high interest rates are bad for stocks and what you can do to protect your portfolio. There are basically three reasons why high interest rates are bad for the stock market, and those are they increase the borrowing cost for companies, they increase the opportunity cost for investors, and finally, they cause the fair value of a stock to come out lower in a discounted cash flow model, which is a typical financial model used to value stocks. I'm going to go through each one of these factors one by one. First, the borrowing cost to companies. A huge part of a company's profit or loss is its interest expense. The more debt it has, the more interest it pays. And interest, like any other expense, is subtracted from revenue to get profit. Now, holding interest rates constant, the amount of debt is the main determinant of what the interest expense is. The interest expense being a cost that the company has to clear before it can turn a profit. However, there are certain situations where interest expense can rise, even holding the amount of debt constant, and one of those is rising interest rates. When the Federal Reserve raises interest rates, be that by affecting the federal funds rate or by selling treasuries, it causes the treasury yield to rise. Over the course of this year, the 10-year treasury and the 2-year treasury have both risen a lot. And of course, other bonds in the market have to compete with the treasury on yields. And even if they're of a different risk profile, their yields will tend to move in the same basic direction. So as the yield on the treasuries rise, the yield on other types of bonds tends to rise as well. And if those bonds already exist before the interest rate hikes occurred, then the way that the yield rises is by the price going down. On the other hand, if a company issues new bonds, then it will have to issue them at a higher coupon rate if it wants to raise the amount of money it wanted to. So no matter which way you slice it and dice it, whether it's through the value of their bonds going down or through having to issue bonds at higher interest rates, companies will pay higher interest expenses when interest rates rise. The second reason why high interest rates are bad for the stock market is because they increase the opportunity cost for investors who are looking to invest in stocks or any other asset. And the key term here would be any other asset. As the treasury yield and the federal funds rate and these other things that the Federal Reserve influences goes up, so too do the yields on fixed income investments that banks offer to their customers, such as certificates of deposits or CDs in the US or GICs here in Canada. What happens is that as the yields on these types of investments rises, it gets to the point where you can get a not insignificant amount of return risk-free. For example, there's a bank here in Canada called Equitable Bank that is now offering 4.5% on 1-year GICs. Now, you might say that that 4.5% still doesn't clear the inflation rate, but keep in mind that all of this interest rate hiking tends to reduce aggregate demand. If the Bank of Canada and the Fed and the other banks that are involved in this manage to get inflation down to the 2 to 2.5% target, then they will eventually get to a point where a 4.5 yield gives you a positive real return. And when you can get a positive real return risk-free, that makes investing in risky assets like stocks a lot less appealing. Now, the final way in which high interest rates cause stocks to go down has to do with the way that stocks are valued. A discounted cash flow model, DCF for short, is a way of valuing stocks. Basically, it values the stock as all of its future cash flows, which are typically earnings or free cash flow per share. In theory, the value of a stock is all of its future profit. If there were no alternative investments other than stocks, no inflation, and no interest rates, you could pretty much just sum all the expected future earnings from a stock and call that its value. However, there are, in fact, other assets, such as US Treasuries, and there is inflation, so you need a stock's earnings or dividends to clear a certain benchmark before it's actually worth investing in. In economics, we call this benchmark the opportunity cost of the investment, as it's the cost of not buying the next best opportunity. Now, when people do discounted cash flow models, they use all kinds of different things as the discount rate. For example, a common one would be the 10-year treasury. Another common one would be the company's weighted average cost of capital, or how much the company has to pay to get access to basically money. And sometimes people even discount at the inflation rate, thinking that clearing inflation is the main goal of the investment. The point is, in a discounted cash flow model, we don't just add up the estimated future profits. We divide each period's profits or cash flows by 1 plus the risk-free rate of return. US Treasuries are considered risk-free. They aren't really risk-free, nothing is, but they're the closest thing to risk-free that exists because they're backed by government taxing power. So they serve as a baseline opportunity cost for investors. Now, as I said, not all investors discount at the treasury yield. Sometimes investors will use higher opportunity costs, otherwise known as discount rates, in order to account for risk. But in general, we can say that when the treasury yield rises, the opportunity cost of investments rises. Now, why do these rising treasury yields tend to crash the stock market? In a discounted cash flow model, I mean, apart from the other two reasons I just explained. Well, we can demonstrate this by looking at two discounted cash flows side by side. Normally, when you're valuing a stock using these methods, the calculations are a little more complicated because you assume that cash flows are going to be produced eternally, and there's something called a terminal value, which I'm not going to get into here. For the sake of demonstration, I'm just going to go with two series of cash flows that last for 5 years side by side. In the first one you see here, the cash flows don't grow at all. It's just 5 payments of $100. As you can see, at 0% interest rates, it's worth $500 at the end. It's worth $472 at 2% interest rates, and finally $397 at 10% interest rates. Going from 0 interest rates to 10 causes the value of these cash flows to go down by 24.2%. Now let's look at these same calculations for an asset where the cash flows grow by 50% each year. As you can see, the sum of these cash flows is way, way higher than the non-growing series of cash flows at every interest rate. At 0 interest rates, they sum to $1,319. At 2% interest rates, they sum to $1,226. And finally, at 10% interest rates, they're worth $929. Again, we're talking the present value, the value after discounting for, that is, dividing by 1 plus the discount rate. Going from 0 interest rates to 10 in the case of this fast-growing cash flow causes these cash flows to go down in value by 29.5%. So the percentage reduction in the fair value of the faster-growing asset is way more severe. Stocks and bonds are both affected by interest rates, but stocks much more so because their cash flows are assumed to grow over time and they are valued with that assumption in mind. Now, you might be saying, sure, but even at the highest interest rate, the fast-growing cash flows are still worth way more than the no-growth cash flows. That's true, but you need to remember the efficient market hypothesis. According to the efficient market hypothesis, most assets will be priced at or near the best estimate of the true value at all times. And if they temporarily deviate from it, the gap will be closed by traders seeking to exploit the opportunity. Therefore, if the efficient market hypothesis holds, then the fast-growing asset needs to fall more than the slow-growing asset when interest rates rise, because both of these assets will be accurately priced before the interest rate hike took hold. So there you have it. The reason why rising interest rates crash the stock market is because they increase the opportunity cost of risky investments. They crash the stock and bond markets all the same, but the riskier and faster growing the asset is, the further it has to fall. That's about it for me today. Feel free to leave any comments you have in the comment box below, and if you liked the video, make sure to hit the like button and share it wherever you go to talk about stocks. That's all for me today. Happy saving!